All right, let's talk about one of the most frustrating things for any trader, the sideways market. You know what I'm talking about, right? Those times when an asset like Bitcoin or gold just isn't trending up or down. It's just stuck, bouncing around in a box. Well, today we're going to show you how to take that boredom and turn it into a super clear and profitable strategy. So I want to start with this question. What if that sideways grind, that thing that looks like nothing is happening, is actually one of the most predictable and profitable places to be? It's all about changing how you see it, turning a boring market into an arena of really clear, repeatable opportunities.
So here's the game plan. We'll kick things off with what this opportunity actually is. Then we'll dive right into the playbook, the step-by-step. After that, we'll talk about how to protect your money, which is crucial. We'll tackle the all-important mental game and then wrap up by figuring out if this style of trading is even right for you.
Okay, so let's get down to the fundamentals. First things first, what are we even talking about when we say a market is ranging or sideways? Let's get a super clear definition on this.
So a sideways market, or a range, is basically just a period where the market takes a breather. Price isn't really making new highs, and it's not making new lows either. Instead, it gets trapped between a pretty consistent high price and a consistent low price. Think of it like a temporary truce between the buyers and the sellers.
Now this is where it gets really interesting because it shows you just how different range trading is from what most people think of as trading. Trend traders, they're like hunters, right? They're looking for that one huge explosive move. But range traders, they're more like farmers. They've got a defined plot of land and they're just profiting from the predictable bounces off the edges. One needs chaos, the other needs stability.
And honestly, this is the perfect way to picture it. Just imagine the price as a tennis ball bouncing in a room. The lower boundary, that's the floor. And in trading, we call that support. It's where buyers keep stepping in. The upper boundary is the ceiling or resistance, and that's where sellers usually show up. Our entire job as range traders is to just systematically buy at the floor and sell at the ceiling. Sounds simple, right? Well, the devil's in the details.
Okay, so let's open up the playbook. This is where we go from theory to an actual, actionable strategy. This is the how-to, where we turn the concept into a plan you can actually put to work. It all boils down to these 4 simple steps. Step 1, identify the range. You can't trade what you can't see, right? Step 2, wait for the price to come to you. This is all about patience. We don't trade in the messy middle. Step 3, look for confirmation. We need some proof that the floor or ceiling is actually going to hold. And finally, step 4, plan your entry and exit. This is where you decide your risk and reward before you even think about clicking a button. So, what does confirmation actually look like on a chart? Well, here are a few really powerful tells. You might see a candlestick pattern like a hammer, with that long wick at the bottom. That's a huge clue that buyers just rushed in at support and aggressively rejected lower prices. It's like, nope, not going down there. Or you could look at an indicator like the RSI. When the price hits support and the RSI is way down in the oversold zone, that's a sign that the sellers are exhausted, which makes a bounce much more likely. And a failed breakout? Oh, we'll get to that one. It's one of the strongest signals there is. Okay, now for what is maybe the most important part of all this. You can have the best strategy in the world, but if you don't manage your risk, you're just gambling. So let's talk about how you protect your capital when you're playing inside this box.
Let's make this super concrete with a hypothetical Bitcoin trade. Imagine Bitcoin is bouncing between 65,000 on the low end and 69,000 on the high end. Simple enough. Your plan is to enter with a buy order right near that support level. Your profit target is going to be just under the resistance at 69K. And here's the key. Your stop loss is set at 64.5. Why there? Because if the price breaks below that support, your whole idea is wrong and you need to get out immediately. This defines your exact risk from the start. No surprises.
I want to stay on this for a second because it's just that important. Think of your stop loss as your absolute non-negotiable safety net. You place it just outside the range, which gives the trade a little room to breathe, but it guarantees you get out with a small, manageable loss if the whole structure just falls apart. So, we have the technical plan. We've got the risk management, but you know what? None of it matters if you don't have the right mindset. Let's get into the mental game, because with range trading, psychology isn't just part of the game, it is the game.
Man, this quote just says it all. The market does not reward you for just clicking buttons and being busy. It rewards you for discipline. A good range trader might only take a couple of high-quality trades a week, just sitting on their hands, patiently waiting for the price to come to the edges where the odds are massively in their favor.
This slide really gets to the core of the internal battle. You've got that voice in your head, the FOMO, telling you to jump into a trade in the middle of the range where there's no real edge. Then you've got this impulse to chase every big candle that looks like a breakout. A successful range trader has the discipline to just ignore both of those temptations and stick to the plan. They trust the boundaries.
And speaking of breakouts, take a look at this chart of gold. We see a nice clean range, right? And then, boom, a massive candle just explodes through the resistance. All the breakout traders are jumping in. They're convinced this is the big one, the start of a new uptrend. This is that moment of maximum temptation. Is this it? Is this the move? And nope. This right here is a perfect example of the false breakout trap. The price shot up, sucked in all those FOMO buyers, and then it slammed right back down into the range, taking out all their stops. Now, for the patient range trader, this failed breakout is actually an amazing signal to sell because you're betting against all those trapped buyers. It's a painful lesson, but a powerful one.
Okay, so we have defined the range. We've gone through the playbook, and we've explored the psychology. Now it's time to bring it all home and turn the focus back on you. Is this style of trading actually a good fit for your personality?
And that brings us to the final and really the most important question. Now that you've seen the playbook, which approach speaks to you more? Are you the farmer who prefers the steady, high-probability work of trading these predictable bounces? Or are you the hunter who lives for the thrill of catching that one explosive breakout? There is no right or wrong answer, but knowing who you are is maybe the biggest secret to consistency in trading.